There's one piece of bad financial advice that I take a little bit more personally than anything else, and that is selling cash value whole or universal life insurance to people who should just be sticking to simple, cost-effective term life insurance. But doctors, particularly incorporated ones, get pitched these things all the time. The charts look impressive. The salesperson is going to seem super confident, and the doctor often starts wondering if they might be missing out on something really valuable and important. At the same time, they often do have a bit of skepticism. Something might not feel quite right. At least that was exactly my experience. About 10 years ago, I bought a cash value policy. I thought I understood it. The illustrations looked straightforward, and I was told that it would give me lifelong coverage. I could access the money tax-free whenever I wanted, and most importantly, it was a really tax-efficient way to pass on a bunch of money to our kids. It sounded sensible to me at the time. So after paying $25,000 in premiums per year for 2 years, I canceled it and ended up with a $27,000 lesson. I hate to admit it, but I let the rosy projections blind me to the fact that I didn't actually understand them. To be honest, even back then, I was pretty financially savvy, and I don't think that I wanted to admit that I just didn't get how cash value life insurance actually worked. Now I know that even the smartest financial planners struggle to understand these things. The other thing that happened around that time was that our family's plans had shifted. I'd signed up for 10 years of premiums, but not long after I did that, I was actually starting to think about stepping back from medicine, having more control over our time, maybe even traveling with the kids, which we did. We traveled around the world for a year as a family. Committing $25,000 a year for 8 more years just didn't make sense all of a sudden. And this is really common. Our plans change, often in unpredictable ways. So here's a few questions I should have asked right from the start that would have saved me this $27,000 lesson. Number one, I should have asked, can you show me a side-by-side comparison of this policy versus the reasonable alternative, which is buying term insurance and investing the difference? I knew how to do this myself at the time, and I'm embarrassed that I didn't. You should ask for this to be done and make sure that they model it realistically with respect to the accounts that they're comparing and the rates of return. Number two, what are all the ways that I'm actually paying for this plan? What are the actual fees? If I had known, for example, that my first year premium was likely paid as a commission to the salesperson and that the internal fees are in the range of 2 to 4% per year for these things, I probably would have just walked away. Number three, can you explain to me exactly how borrowing against the policy in retirement would actually work and what the risks are? What I know now is that borrowing in retirement, particularly the huge amounts that would be involved with a cash value insurance policy, is just not compatible for most of us with feeling financially secure. Retirees want less risk, not more. And there are huge risks with this, particularly if you live a long time or if interest rates go up in the future, which of course is completely unpredictable. It absolutely could happen. The fourth question I should have asked is, will my estate receive both the cash value and the death benefit, or only the death benefit? I was pretty enamored with the charts I'd been shown, but if I had realized that that tempting big cash value balance I saw in the sales material would just be taken by the insurance company at the time of my death, I probably would have realized that term life insurance was the better option. So if I had asked those questions and got clear answers, I would have understood the policy much earlier and frankly would have made a very different decision from the start. Cash value insurance can serve a purpose in a few narrow situations, but the vast majority of physicians do not fall into those categories. In fact, I haven't met one where a big cash value life insurance policy was the best solution for their financial plan. This is not a secret wealth strategy of the super wealthy that you're missing out on. Complex and sophisticated are two very different things. Complexity should be a red flag, not a selling feature. learn from my mistake. If you don't understand something, just don't get involved with it.